For almost 6 centuries, a quiet pattern has run beneath the surface of world history. 5 different currencies have risen to dominate global trade and finance. All 5 lost that privilege, not by chance, but by moving through the same 8-step sequence until their power evaporated. It begins with genuine dominance, a nation that really does produce more, trade more, and project more military force than anyone else. Its money becomes the natural language of global commerce. Then, the empire stretches itself across seas and continents, taking on military and political commitments that cost more than its real economy can sustain. Deficits become permanent. Debt piles up. To keep everything going, the issuer manipulates the money itself. Debasement in the old world, money printing and credit expansion in the modern one. Inflation eats away at purchasing power. Foreign creditors and trading partners slowly lose faith, look for alternatives, and begin shifting their reserves and trade away from the once dominant currency. By the time reserve status is gone, the process has been underway for years. The United States dollar sits inside that pattern today. Since 1944, it has been the central pillar of the global monetary system, the unit in which oil is priced and most international debts are settled. It has held that position for about 80 years, almost exactly the historical average lifespan of previous reserve currencies. The United States moved from overwhelming industrial and military dominance after World War II to worldwide bases and commitments to chronic deficits and unprecedented money creation. Now it has entered the fragile stage where confidence is quietly eroding, even if most people still assume the dollar's rule is permanent. To understand why that matters, we have to be clear about what a reserve currency really is. It is not just the money used in shops and salaries at home. It is the money other countries are forced to hold in their central banks, because the global system is built around it. Commodities such as oil, wheat, copper, and gold are quoted in it, and large international contracts are settled in it. If your currency holds that role, every other nation must own it simply to participate in world trade. Imagine you are the United States inside that system. You want German cars, Japanese electronics, South Korean chips, Chinese manufactured goods. In a normal world, you would have to earn those goods by exporting something of equal value. But as the issuer of the reserve currency, you can pay with dollars that only you can create. Germany needs dollars to buy energy. Japan needs dollars to settle trade. China needs dollars in its reserves to stabilize its own currency. So they accept your new dollars in exchange for real products and real labor. That is the heart of the privilege. Year after year, America imports more than it exports and runs trade deficits that would crush a weaker currency. Yet the dollar does not collapse because the world still needs it. Washington also borrows at unusually low interest rates, not because U.S. finances are uniquely disciplined, but because foreign governments and institutions require a deep, liquid place to park their dollar savings, and U.S. Treasury bonds are the only market large enough. When the Federal Reserve expands the money supply, part of the resulting inflation is exported. Extra dollars spread across the globe and dilute purchasing power in every country that holds them. Other nations quietly help pay the bill for America's spending. This advantage underpins much of what people recognize as American power, a global military presence and a standard of living beyond what domestic productivity alone would support. Yet history is unforgiving. No reserve currency has ever held that status forever. Each one has followed the same arc from rise to overreach to decline. To see how this began, we go back to a small kingdom on the edge of Europe in the 15th century. In 1450, Portugal was not yet an empire, just a narrow strip of land facing the Atlantic. Under Prince Henry the Navigator, Portuguese captains pushed into the unknown, mapping the west coast of Africa, discovering new islands, and opening sea routes to India and, eventually, Brazil. Those voyages rewired global trade. Until then, Spices and luxury goods from Asia had crept into Europe along slow, dangerous overland routes. Portuguese ships suddenly offered a direct ocean highway. They built trading posts along the African coast, in the Indian Ocean, and later in Asia and South America. Gold from West Africa, spices from the East Indies, and sugar from Brazil began to flow into Lisbon. The Portuguese real, backed by this stream of high-value goods, became the ticket into this new commercial network. Merchants across Europe accepted it because they knew it could be turned into real wealth at Portuguese ports. For roughly 80 years, from the mid-1400s to about 1530, the real functioned as the world's first true international reserve currency. If you wanted to participate in the most profitable trades on Earth, you needed reals in your strongbox. This was stage one in its purest form, monetary dominance earned through genuine economic advantage. But Portugal was small, with perhaps 1.5 million people trying to hold an empire that sprawled across 4 continents. Success tempted the crown to push ever farther. Forts had to be garrisoned. Fleets had to patrol sea lanes, fighting rivals and pirates. Colonial administration and defense demanded troops, ships, and constant spending. Stage 2, overextension, arrived as a web of obligations that became too heavy for such a small society to carry. By the early 1500s, the costs of empire were overtaking the profits from trade. The Portuguese crown slid into stage 3, chronic deficits. To bridge the gap, it borrowed heavily from Italian and German bankers and sold off future trading revenues for cash today. When creditors grew cautious and demanded higher returns, the monarchy reached for the money itself. In that era, money creation meant debasement, quietly reducing the precious metal content of coins while keeping the face value the same. Gold and silver coins that had once been pure were mixed with cheaper base metals. More coins could be minted to pay soldiers and suppliers, but merchants noticed. They weighed the new coins, saw they contained less metal, and raised their prices. The real's purchasing power fell. Inflation began to bite. By the 1520s, maintaining the empire required more and more debased coins each year. Foreign traders became wary. Around 1530, many no longer wanted Portuguese coins at face value. They preferred Spanish silver pouring in from New World mines, which they trusted more. That quiet shift in preference was stage 6, the loss of confidence among those who mattered most to the currency's status. Portugal survived as a nation, but its time as issuer of the world's reserve currency was over. The real lost the special role that had allowed the kingdom to live beyond its means. The pattern had completed its first full cycle. And just as Portugal's monetary power faded, another empire was stepping forward, armed with mountains of silver and an even greater ambition. Spain's ascent to monetary supremacy began with blood and conquest on the other side of the world. While Portugal had threaded narrow trade routes along the African coast and into Asia, Spain crashed directly into vast inland empires rich with metal. In 1519, Hernán Cortés toppled the Aztec Empire in what is now Mexico. A little over a decade later, Francisco Pizarro dismantled the Inca Empire in the Andes. Behind the drama of conquistadors and collapsing civilizations was something colder and simpler: silver. More silver than Europe had ever seen. From the mid-1500s, the mines of Potosí in today's Bolivia and Zacatecas in Mexico began disgorging hundreds of tons of silver each year. This was not a trickle, it was a flood. Spanish galleons carried it across the Atlantic, through Seville, and back out again into Europe, the Mediterranean, and via trade routes all the way to China. The pieces of 8, the Spanish dollar, became the first truly global industrial-scale currency, recognizable and accepted in markets from Manila to Amsterdam. For roughly 110 years, if you were settling large transactions in the known world, you were likely using Spanish silver. This was stage one again, now amplified. Dominance backed not just by trade, but by a near monopoly on the precious metal that everyone else wanted. Spain effectively sat on half the world's silver supply. The coins were of standard weight and widely trusted. Holding Spanish dollars was like holding the raw material of money itself. Yet that very abundance carried a hidden poison. It encouraged the illusion that more mines, more ships, and more silver could solve every political and military problem. The Spanish monarchy did what powerful states almost always do when a river of wealth suddenly opens in front of them. It tried to turn money into empire everywhere at once. Spain claimed enormous swaths of the Americas, held territories in Europe, and extended its reach into Asia through the Philippines. It fought the Ottoman Empire in the Mediterranean, battled England at sea, waged war against France on land, and tried to crush Dutch rebels in the Low Countries. It was fighting on multiple fronts, across multiple continents, in an age when logistics depended on wind and muscle. Stage 2, overextension, had arrived in spectacular fashion. Even with all that silver, the numbers did not add up. The crown's expenses outpaced its revenues. Armies had to be paid, ships had to be built and repaired, fortresses supplied. By the 1560s, Spain had slipped into the third stage, perpetual deficit spending. The monarch borrowed with increasing desperation from Italian and German bankers, pledging future silver shipments that were already spoken for. Officially, the empire was rich. Practically, its cash flow was under constant strain. When borrowing was not enough, Spain turned to the same mechanism that had tempted Portugal, manipulating the currency itself. Instead of printing paper, they began quietly diluting the metal content of their coins. A coin stamped with a familiar denomination no longer contained the same amount of pure silver. The surface image remained, but underneath, more copper and less precious metal changed the reality. This was stage 4, the early modern version of money printing. Merchants and traders are never fooled for long. They weighed the coins, tested them, noticed the decline. As trust in the purity of Spanish money slipped, prices rose to compensate. Inflation took hold, not in a sudden hyperinflationary blaze, but as a persistent upward creep in the cost of living and doing business. Imported goods became more expensive, and even domestic goods began to reflect the weakening currency. Stage 5 was underway. The tragedy of Spain is that it managed to go bankrupt repeatedly while controlling colossal natural resources. Between 1557 and 1647, the Spanish crown defaulted on its debts 4 separate times. Each default was a public confession that even with its silver monopoly, the empire could no longer honor its promises. Foreign lenders learned the hard way. Confidence, the true backbone of any reserve currency, began to fracture. By the 1620s, merchants increasingly demanded to weigh Spanish coins or discount their face value. This was stage 6 made visible, the slow, humiliating erosion of trust in what had once been the world's most coveted money. As Spain stumbled, new competitors were rising in the cold, flat lands of Northern Europe. The Dutch Republic, born out of rebellion against Spanish rule, built something Spain had never truly mastered: a sophisticated financial system. In the early 1600s, while Spanish silver still clinked in purses around the world, Amsterdam was quietly becoming the counting room of global trade. The Dutch did not have gold and silver mines of their own. What they had were ships, merchants, and a culture of commercial pragmatism. They founded the Dutch East India Company, one of the first great joint stock corporations to coordinate trading ventures to Asia. They created the Amsterdam Stock Exchange in 1602, allowing investors to buy and sell shares in these ventures. In 1609, they established the Bank of Amsterdam, a trusted institution that standardized and cleared payments for merchants from across Europe. Out of this network emerged the Dutch guilder as the next reserve currency. Its strength was not in the metal content alone, but in the reliability of the system behind it. Bills could be settled through the bank with confidence. Deposits were secure. The rules were transparent by the standards of the day. This was stage one in a more modern guise, dominance through financial innovation and trade efficiency, rather than sheer bullion. Yet even the Dutch, with their careful accounting and commercial discipline, could not escape the gravitational pull of the eight-stage cycle. Their republic was small, barely a few million people, trying to maintain a vast web of trading posts, colonies, and defended routes. They fought England in a series of brutal naval wars over control of the seas. They struggled with France over influence on the continent. The costs mounted. Overextension crept in, almost inevitably, as they tried to remain everywhere their profits called them. To sustain this reach, Dutch governments and companies leaned heavily on credit. Banks extended more loans. Paper claims on money multiplied. The money supply grew faster than the real economy beneath it. Inflation did not explode, but purchasing power gradually eroded. Investors began to look to a new rising power across the channel, where coal, iron, and machinery were setting in motion forces that would reshape the world entirely. By the early 1700s, London was on its way to displacing Amsterdam as the beating heart of global finance. The British pound, anchored to an industrializing economy and a rapidly expanding navy, started to edge out the guilder in long-distance trade. It did not happen overnight. Reserve currencies rarely fall with a single dramatic crash. Instead, contracts were slowly rewritten, merchants opened accounts in new banks, and central authorities diversified their holdings. The Dutch guilder remained respectable, but the invisible crown of world's reserve currency passed to the pound sterling. The pattern had repeated again, and with Britain it would reach its largest, most dramatic expression. Britain's turn at the center of the monetary universe began not with a single discovery of metal or a single decisive battle, but with a slow-burning transformation in how things were made. In the 18th century, the Industrial Revolution started turning coal and iron into engines, railways, and machines that could produce goods on a scale no previous empire had imagined. Textiles from British mills flooded world markets. Steamships and railways shrank distances. The Royal Navy guarded trade routes that reached into every ocean. London became the place where capital was raised, insurance was written, and global deals were settled. Out of this convergence of industry, finance, and naval power, the pound sterling emerged as the default language of international commerce. This was stage one in its most extended form, dominance through genuine economic and military superiority. Britain produced more steel, more ships, and more finished goods than any rival. Its banks developed sophisticated practices for financing trade, and sterling-denominated bills of exchange circulated around the world. If you wanted to buy cotton from India, tea from Ceylon, rubber from Malaya, or raw materials from Africa, prices were quoted in pounds. The phrase, "the sun never sets on the British Empire," was not just poetic. It meant that somewhere on Earth, at every hour of the day, someone was settling a bill in sterling. But just like Portugal and the Netherlands before it, Britain began to take this dominance for granted and pushed its reach to the limit. By the late 19th century, the empire spanned a quarter of the world's land surface and population. Maintaining this system required garrisons in India, administrators in Africa, naval patrols in the Pacific, bases in the Mediterranean, and interventions wherever unrest threatened trade. At the same time, new industrial powers were rising. Germany unified and became a manufacturing powerhouse. The United States grew into an economic giant with continental resources. Britain still led, but the gap was closing. Stage 2, overextension, was now embedded in the very geography of the empire. The bill for that overextension came due in 1914. World War I was not just a clash of armies, it was a financial earthquake. Britain poured staggering sums into the war effort, financing weapons, ships, and supplies on a scale no previous conflict had demanded. To sustain it, the government borrowed massively, including from the United States, and sold off foreign investments that had once generated safe income. Deficits that would have seemed unthinkable a generation earlier became the norm. When the guns finally fell silent in 1918, the casualty lists were horrific, but the balance sheet was also shattered. Britain had entered Stage 3, structural deficit spending, no longer a temporary wartime emergency, but a chronic condition. The monetary response was conflicted and, in hindsight, tragic. Before the war, the pound had been firmly tied to gold, symbolizing solidity and trust. During the war, that link was suspended. After it, British policymakers tried to turn back the clock. In 1925, they attempted to restore the pre-war gold parity, pretending that nothing fundamental had changed. But the economy had been damaged, debts were immense, and other countries had moved on. To defend the old exchange rate, they squeezed the money supply, pushing the domestic economy into deflation and unemployment. It was an attempt to hold on to a symbol of strength that no longer matched reality. When the strain became unbearable, Britain abandoned gold again in 1931 and began a more explicit expansion of the money supply to combat the Great Depression. Stage 4, monetary manipulation and expansion, was underway, even if it wore the language of technical policy. Then came a second, even more devastating war. From 1939 to 1945, Britain once again mobilized everything it had and much that it did not have. The government borrowed on an enormous scale, relied on American support through arrangements like Lend-Lease, and quietly allowed prices to creep upward. By the end of World War II, Britain had won militarily but was crushed financially. The empire was intact on maps, but beneath the surface, the numbers no longer supported the illusion. Inflation eroded the value of the pound. Rationing continued for years after peace. The currency that had once defined stability was now visibly fraying. Stage 5, persistent inflation and eroding purchasing power, had become a daily experience for ordinary people. It was in this weakened condition that Britain arrived at Bretton Woods in 1944, the conference where the architecture of the post-war monetary order would be decided. Officially, London still claimed leadership. Emotionally, many policymakers could not imagine a world where sterling did not sit at the center. But the hard facts pointed elsewhere. The United States now held the majority of the world's gold reserves. Its factories were undamaged by war, its economy booming. While European cities lay in ruins, American industry was at full capacity. The other delegates knew this. Behind the speeches and negotiations was an unmistakable reality. Confidence in the pound as the anchor of the global system was gone. Stage 6, loss of confidence, played out diplomatically as the world quietly chose the dollar instead. Bretton Woods formalized Stage 7 for the pound, the emergence of a clear alternative. The US dollar, convertible into gold at a fixed rate, was designated as the new primary reserve currency. Other currencies, including sterling, were pegged to the dollar rather than gold directly. Central banks began to accumulate dollars for their reserves instead of pounds. International contracts shifted into the new unit. Britain tried to manage the decline with controlled devaluations in 1949 and again in 1967, episodes that publicly acknowledged sterling's weakening status. By around 1970, the transformation was effectively complete. The pound remained an important national currency, but it no longer conferred the extraordinary privilege of reserve status. Britain's geopolitical influence shrank accordingly. In the span of a generation, it went from ruling a quarter of the globe to navigating life as a mid-sized power. Stage 8, the final loss of reserve status, did not look like an explosion. It looked like a long fade punctuated by moments of crisis. Across these four stories, Portugal, Spain, the Netherlands, and Britain, a single pattern repeats with eerie consistency. If we step back from the details of voyages, battles, and policies, we can see the 8 stages more clearly. First comes dominance, earned through some real advantage. Portuguese exploration, Spanish silver, Dutch financial innovation, British industrialization and empire. In each case, the currency of the leading power naturally becomes the lubricant of global trade. People hold it not because someone forces them to, but because it is the most convenient and trusted option in a world built around that power's networks. Then, almost inevitably, comes overextension. With dominance comes ambition, and the temptation to project power everywhere. Fleets multiply, armies are stationed overseas, alliances are built, colonies are governed, wars are fought to protect markets and prestige. The issuing nation takes on burdens that a more cautious reading of its balance sheet would reject. It feels affordable because the world keeps accepting its currency. That leads directly into structural deficits. Expenses outrun revenues, not for a year or two, but as a persistent condition. Governments borrow to cover the gap, telling themselves that growth or victory will someday catch up. When borrowing alone is no longer enough, the issuer reaches its most dangerous tool, money creation. In the pre-modern world, that meant shaving edges off coins, mixing base metals into precious ones, or issuing paper notes in excess of gold or silver reserves. Today, it means central banks expanding their balance sheets, governments issuing more debt that is effectively monetized, and digital entries adding trillions to the money supply. However it is executed, the pattern is the same. The supply of currency grows faster than the real economy. That, in turn, births stage 5, inflation. Sometimes it is explosive, sometimes relatively controlled, but in every case, the currency buys less over time. People notice prices rising. They may not follow monetary policy debates, but they feel rent, food, and energy becoming more expensive. If the currency is the global reserve, some of this pressure is pushed abroad as foreign holders absorb the excess. Yet even then, the erosion of purchasing power cannot be completely hidden. At some point, a line is crossed that can only be recognized in hindsight. Foreign governments, central banks, and large investors begin to question whether holding this currency is worth the risk. They look at the deficits, the money creation, the political trajectory, and the alternatives available. Quietly at first, they reduce their exposure, diversify into other assets, and demand better terms. This is stage 6, the loss of confidence. It is a psychological turning point as much as an economic one. Once that trust breaks, stage 7 becomes possible. Credible alternatives appear or strengthen. Another country or group of countries offers a currency backed by a more disciplined fiscal position, a stronger real economy, or a new kind of financial architecture. Trade contracts are rewritten, reserves are rebalanced, and over a period that can feel slow in the moment, but looks fast in the rearview mirror, the old reserve currency's centrality fades. Stage 8 is simply the final recognition of that shift. The old issuer finds that it can no longer borrow on the same easy terms, no longer export inflation at will, no longer sustain the same standard of living without painful adjustment. The currency may survive, even remain important, but the special privilege is gone. This is the script that has played out step by step for 5 centuries. And now, for the first time in modern memory, people are daring to ask whether the same 8 stages are unfolding again, this time with the United States dollar in the lead role. The dollar's reign began in the ruins of a world war. By 1944, As Allied leaders gathered in a quiet New Hampshire hotel at Bretton Woods, much of Europe and Asia lay shattered. Factories were bombed out, railways twisted, cities reduced to ash. But one industrial giant stood almost untouched: the United States. Its factories were humming, its farms were productive, its population was intact. The U.S. held the majority of the world's gold reserves and nearly half of global economic output. It was only logical, almost natural, that the new system would be built around the American currency. From that point on, the dollar became the central reference point of the global economy. Foreign currencies were pegged to it. The dollar, in turn, was promised to be convertible into gold at a fixed rate. If you wanted to trade oil, machinery, food, or raw materials across borders, you needed dollars. Banks stocked them. Central banks accumulated them. The first stage of the pattern, dominance through real economic power, was clear and undeniable. Unlike Portugal or Spain, America's strength did not rest on a single commodity or route. It rested on a diversified, technologically advanced economy backed by enormous natural resources and a powerful military that had just helped win the largest war in human history. Then, slowly, the familiar temptation appeared. After World War II, the United States assumed global responsibilities that no previous power had ever attempted on such a scale. It anchored alliances in Western Europe, underwrote Japan's reconstruction, guaranteed security for South Korea and Taiwan, extended nuclear deterrence, and later involved itself deeply in the politics of the Middle East and beyond. The Cold War layered an ideological contest on top of these commitments. Military bases spread to dozens of countries. Navy carrier groups patrolled every major ocean. By the end of the 20th century, U.S. forces and obligations encircled the planet. It was Stage 2, overextension, in its most expansive modern form, a network of promises that required constant money to uphold. At first, the underlying economy could absorb the cost. America was rich, innovative, and productive. But over time, spending rose faster than revenues. Domestic programs grew. Wars in Korea, Vietnam, Iraq, and Afghanistan added their own bills. Crisis after crisis, recessions, oil shocks, financial turmoil, was met with new interventions, bailouts, and emergency measures. By the turn of the millennium, the federal debt had climbed to trillions. Politicians, unwilling to raise taxes to match spending, chose the easier path: borrowing. Deficits stopped being temporary responses to emergencies and became a permanent feature of the budget. Stage 3 had arrived. The country was living, structurally, beyond its means, shielded for the moment by the trust the world still had in its currency. Then came the era of unprecedented money creation. When the global financial system nearly imploded in 2008, the U.S. Federal Reserve responded with a policy that would have sounded extreme in earlier decades: quantitative easing. It bought vast quantities of government bonds and other financial assets, effectively creating new dollars inside the banking system. What began as a targeted emergency response hardened into a recurring tool. The Fed's balance sheet swelled. Interest rates sank towards zero. Asset prices climbed. The deeper implication was subtle but vital. The line between fiscal policy and money printing had blurred. In 2020, when a global pandemic froze large parts of the world economy, the response took this logic to its extreme. Governments passed enormous spending packages, much of it financed indirectly by central banks expanding the money supply at record speed. In just a couple of years, the stock of dollars in existence jumped by levels that would once have been associated with unstable regimes, not with the issuer of the global reserve currency. It was Stage 4, rewritten with digital precision, money printing on a scale that older empires could only have dreamed of, now executed with keystrokes rather than coin hammers. The consequences were not instant, but they were inevitable. By 2021 and 2022, inflation that had been subdued for decades flared up. Prices for food, energy, housing, and everyday goods rose at the fastest pace in a generation. Official numbers reached multi-decade highs. Lived experience felt even harsher for many households. Wages tried to catch up, but the ground was moving beneath people's feet. For a while, it was fashionable to call the surge transitory, a temporary result of supply chains and shocks. Yet beneath these explanations was a mathematical reality. When you rapidly increase the number of dollars chasing roughly the same amount of goods, each dollar loses some of its power. Stage 5, noticeable, painful inflation, had arrived in the heartland of the reserve currency issuer. To fight that inflation, the United States did what textbook economics prescribes. It raised interest rates sharply. That cooled some price pressures, but made the debt more costly to service. Each percentage point increase in rates translated into tens or hundreds of billions of dollars in additional interest payments. Meanwhile, the overall debt continued to grow. The system still functioned, but the foundations were visibly creaking. Observers abroad began asking a dangerous question. If this is how the world's safest asset behaves, how safe is it really? That question takes us straight into stage 6, the slow, quiet loss of confidence among the very players who hold the dollar's fate in their hands. Over the past 2 decades, the share of global foreign exchange reserves held in dollars has steadily declined. It has not collapsed, but it has slipped from a commanding supermajority to a smaller, though still dominant portion. Major holders like China have reduced their positions in U.S. government debt. Russia, after sanctions made clear how vulnerable dollar reserves can be to geopolitical pressure, moved dramatically away from the currency. A loose coalition of countries, often grouped under acronyms like BRICS, has begun experimenting with ways to trade outside the dollar system, whether through bilateral currency agreements, new payment networks, or discussions of commodity-linked alternatives. None of these steps, on its own, destroys the dollar's status. The U.S. financial system remains deep and liquid. The country still wields immense economic and military power. But taken together, these moves echo the behavior seen in earlier eras when merchants and governments began to quietly favor Dutch guilders over Spanish silver or dollars over pounds. Reserves are diversified. Contracts are denominated in new units. The direction is subtle but unmistakable. That is what loss of confidence looks like in real time. Not a bank run at a teller window, but a steady reweighting of portfolios in boardrooms and central bank offices across the world. Stage 7 is not fully formed yet, but its outlines are visible. The Chinese yuan is gradually being used in more trade, including energy deals that would once have been unthinkable outside the dollar system. The euro, despite its internal challenges, remains a significant alternative store of value. Some nations are exploring central bank digital currencies that could, in theory, bypass traditional dollar-based infrastructure. Even decentralized options like Bitcoin, though far from replacing state money, have entered the conversation as potential pieces in a future mosaic of value. None of these rivals has yet assembled all the ingredients of a fully dominant reserve currency. But the pattern does not require a single immediate successor. It only requires that credible alternatives grow strong enough for the old monopoly to break. Stage 8, the full loss of reserve status, lies ahead, unwritten but hinted at by 5 centuries of precedent. If and when it arrives, it will not simply mean that the dollar is worth less. It will mean that the United States can no longer borrow limitless sums at unusually low rates without immediate consequences. It will mean that deficits that were once shrugged off as abstract numbers suddenly collide with market discipline. It will mean that inflation can no longer be exported so easily abroad, forcing Americans to bear more of the burden themselves. The standard of living built on 80 years of monetary privilege would have to adjust to what the underlying productive capacity of the economy can truly support. Could this time be different? That is the hope that every dominant power has clung to. Portugal believed its maritime routes were unassailable. Spain believed that rivers of silver guaranteed permanent supremacy. The Dutch believed that superior financial engineering would protect them. Britain believed that an empire spanning the globe ensured lasting control. Each thought their system had unique features that exempted them from the hard mathematics of overreach and debasement. All of them were proven wrong, not in a day, but over a human lifetime. The United States has its own version of this story. It believes, often sincerely, that its technology, its military, its culture, and its political ideals make it exceptional. In many ways, they do. But the underlying pattern of debt, deficits, money creation, and foreign confidence does not change because of national mythology. The dollar sits at stage 6 of the 8-step cycle. Its dominance still real, but its aura of invincibility fading. Alternatives are forming. Capital is quietly probing for exits. The timeline is uncertain, but the direction is familiar. When the final shift comes, whether in 10 years, 20, or in some sudden moment catalyzed by crisis, it will feel, to many, as if American power has evaporated overnight. In reality, the process will simply have reached its logical conclusion. The ability to print the world's money and send it abroad in exchange for goods, services, and obedience will be gone. The world will reorganize around new centers of monetary gravity. Life in the United States will go on, but the country will, for the first time in living memory, have to live strictly within the limits of what it can produce, tax, and borrow without special privilege. The answers to how and why this happen are not hidden in the future. They are written in 575 years of monetary history, in the rise and fall of 5 great reserve currencies that all believed, in their own time, that the pattern would somehow spare them. It never did. The question now is not whether the pattern exists, but whether we are willing to see it before it completes its work again.